Hey everyone, this is Connor from Zero DTE Traders. We specialize in zero DTE options trading, meaning we focus on trading options on the day of option expiration in order to generate income from the sale of short options. In this video, we'll discuss one of our income strategies known as the Iron Condor. Let's look at an example, zero DTE on the SPX. The SPX is currently trading for 41.50, and we expect the market to remain within a range of 41.75 on the upside and 41.20 on the downside. If this is the case, we can enter a zero DTE call credit spread by selling the 41.75 strike and then buying the 41.80 strike 5 points above for protection. And then in parallel, we will enter a put credit spread by selling the 41.20 strike and buying the 41.15 strike 5 points below for protection. When we create this combination with a short call spread and a short put spread, it creates an Iron Condor and a profit zone. In this case, 55 points, the distance between the short call strike and the short put strike. If price closes within this zone at expiration, we collect the full premium received. Let's break down the cash flow. In this example, we are trading one option contract with each contract representing 100 points. Therefore, we will multiply each figure by 100. We sold to open one SPX 41.75 call for $180. This is a credit to our account. We bought to open one SPX 41.80 call for $120. This is a debit to our account. On the put side, we sold to open one SPX 41.20 put for $215. This is a credit to our account. And we bought to open one SPX 41.15 put for $175. This is a debit to our account. The maximum profit is the net premium received, in this case $100. We will receive the maximum profit if SPX closes anywhere between 41.75 and 41.20. The maximum loss is the width of the widest spread less the premium received. The width is simply the distance between the short strike and the long strike. In this case, they're both 5 points. Therefore, our maximum loss is $400. This example is rather conservative. We have narrow spread widths, 5 points. That's one strike. So that's the narrowest width you can have. We are also pushed pretty far out of the money, increasing the size of that profit zone. If you prefer a slightly more aggressive approach or you want to collect more premium, you can increase the spread width, so the distance between the short strike and the long strike, or push the short strikes closer to the current market price. There are pros and cons to both, but it really comes down to market conditions, option pricing, and personal preference. Individuals vary in account size, risk tolerance, etc. An Iron Condor is a neutral market strategy that benefits from low volatility range-bound trading. But how do you know when the conditions are right to sell an Iron Condor? I will give you a couple tips. Now, for those who trade with us, know we like to utilize market internals and cross-asset analysis to generate a view on direction and volatility. When signals are neutral or mixed, it usually indicates low volatility and a sideways type market. For Iron Condor trades, we focus on the advanced decline line. So ticker symbol ADD, and this is looking at market breadth for the NYSE. And the zero line is considered neutral. And what we like to see is the market as close to that zero line as possible, or just kind of trading in and around it. I generally say plus 800, minus 800, good Iron Condor zone. In addition, we want to see mixed sector performance. Recall, this strategy works very well if we're seeing sector rotation. And how do we determine that? We simply want to look at sector performance. Now, we can look at it via a market cap weighted, which we have an indicator for that, or you can simply just look at defensive, cyclicals, and growth. And if they're mixed, right, you got some sectors down, some sectors up, mega caps, some red, some green, good indication of sort of just mixed performance, perhaps rotation, and generally another good indication of low volatility. So using those two in tandem could give you a good indication if it's an iron condor type of day. Now, if you're looking at market internals and everything is green in positive territory, you may want to have an upside bias, right? Conversely, if everything is red in negative territory, you probably want to have a downside bias. But when conditions are mixed, neutral, generally a good indication that there's not a whole lot of directional bias in the market, and you're more likely than not to see low volatility. For a comprehensive breakdown on how to analyze market internals, a video link is in the description. Also, find a full breakdown on a put credit spread trade and a call credit spread trade in the description. You got 3 video links there. And if you're not a member and you're interested in learning more, you want to join the team, visit our website at 0dtetraders.com. Hope to see you soon.